Hey, what's happening, everyone? Welcome to the Free to Grow CFO podcast, where we talk about all things scaling a D2C brand with a profit focused mindset. I'm your host, John Blair, founder of Free to Grow CFO. And for those of you that don't know, Free to Grow is an outsourced accounting and fractional CFO firm built exclusively for growing profit focused ecom brands. All right, today I'm super stoked to be chatting with my buddy Bryan Cano, VP of Marketing at Nood. He and I have been working together at Nude for about a year and a half. Had some really interesting experiences together, driving forward the growth of that brand. I'm not going to take credit for driving forward the growth because it's not me. It's Bryan and the other incredible marketing resources at Nude. But we've worked hand in hand on how we balance the scaling of the brand from a paid acquisition standpoint and balancing that against profitability and cash flow. And so I'm super excited to have Bryan. Today's talk is going to be chock full of tons of nuggets for you D2C brand operators. So Bryan, welcome. Appreciate having you on, man.
Thanks, John. I appreciate it. Yeah, excited to finally join. I know we've been talking about this for months, and it's great to finally make time and chat with you.
It's hard to get into your schedule, man. You're a busy dude, rightfully so, doing big things over there at Nude. So look, for the audience, I want you guys to all understand we're going to continue the conversation that we had on our last episode of this, delicate dance that you have to manage as you're scaling a D2C brand, where you're balancing leaning into paid advertising as you're scaling, having to maintain efficiency and balance that with how it's driving profitability. And then there's even the cash flow component of all of this. Got into some really interesting discussions talking with Ryan Rouse on our last episode. And I'm really stoked to have Bryan here because he has much more of a focused marketing background that's led up to his time at Nude. And so I think that you're all going to find some really, really helpful tips and traps to avoid as you're working on scaling your own D2C brand. So before we really get into the weeds on this topic, Bryan, I'd love for you to just take the audience through a little bit about your background and your entrepreneurial journey that ultimately, ended. Journey is not over, but in this chapter, ended with you arriving at Nude.
Okay, yeah. Well, you see, when I was 3 years old, no, I'm just kidding. I think it really began for me in college out of necessity to pay through school. It had nothing to do with marketing, but I didn't realize at the time that that's what I was doing. And it was in college. I was working at an accelerator program where they were doing seed investments, 50 to $100,000 checks to multiple startups. I was volunteering, right? I wasn't getting paid, but I was just kind of there and I was around, and I was like, oh, this is really interesting. I like, I want to be an entrepreneur, and I want to be around some of these folks that think this way. And one of these guys, he was the CMO, or he was like the VP of digital over at Cellucor. It's a nutrients company, but he
Mm.
was, doing this like Amazon arbitrage thing, and he taught me a lot about that private labeling, and I was like, okay, this is awesome. So, really, my marketing career kicked off when I, sourced some products from China. This is back in 2014 as well, and we needed to sell them, so did kind of like an email sign up, a very simple website, and ran ads. And I was like, awesome. And, I turned this small investment and doubled it. And I just did that. And like, that's pretty much how I went through and paid my way through college. Fast forward, ended up starting my own agency. And I shuttered the agency because I couldn't scale it in terms of human, like resourcing. I had the clients, but I just couldn't find the right people that were as passionate about this as I was. And so shuttered the agency and ended up working at a different ad tech firm called Stitcher Ads. At Stitcher Ads, I became the senior director of media strategy, creative media strategy, and then I basically worked with a series of enterprise, Fortune 500 brands, retailer and non-retail brands, and oversaw creative and media strategy. We ended up getting acquired, and during the acquisition, I ended up becoming the director of efficacy at the company that we were acquired by. And that's just a long title of saying that I was in charge of measurement. So I ended up being in charge of measurement and media strategy for the entire organization, continued to work with the existing brands. And this is kind of where I start to look for more. And a mutual friend of Sam Garst, who's the founder at Nude, and myself, he introduced Sam and we hit it off, had a couple of beers, and I ended up joining Nude as a contractor in October of 2021. So right before holiday. And that was kind of the start of the journey with Sam and I. I stood as a contractor, and during that period, we were scaling aggressively, and it got to a point where it just made sense for me to join full time. So, we was sort of accidental. I wasn't looking, but that mutual friend of ours, I think they were like on a trip to Cancun or something. They were on the beach in Mexico, and Sam was just complaining about how he couldn't get past a certain point. The business was having a hard time scaling, and Peter, shout out Peter, was like, "Hey, you need to talk to my buddy Bryan." And so that's really sort of how Sam and I got together and started working on Nude.
I love it. Just for the audience's sake, Sam is going to be on the podcast sometime several weeks from now. We're still working on getting him scheduled. He's a super busy guy, CEO at Nude. You'll be able to hear the story from his point of view. Hopefully he talks about it in similar light, finding Bryan. No, that's a joke. But okay, so there's a couple things I want to double click into here. So I started working with Nude as a fractional CFO, I believe in July of 2022. So about a year and a half-ish ago, getting close to 2 years. And I remember meeting Sam and him saying, going to a team happy hour that he invited me to. You were there. That's where I met you. And I remember Sam saying this distinctly to me. I love Bryan because he's not afraid to spend ad dollars. And now that might sound kind of weird to people listening, because I think a lot of D2C brands are really concerned about the irresponsible spend that oftentimes happens, right, from ad buyers and both independent, freelancers, in-house ad buyers, and also on the agency front. But my perspective has really, really changed on scaling, having worked with you, because I would say before meeting you, I was on that other side of the fence, which a lot of our audience probably is that like, oh, ad buyers just want to spend all my money and frivolously, because they oftentimes get paid a percentage of ad spend or a percentage of revenue, right? And so it's just in their best interest. But working with you, I really realized, let's be honest with ourselves, unless you have another acquisition engine outside of paid advertising, which there are some brands that do, there are some creator-led brands that have really strong organic, kind of like top of funnel, right? But that's not most brands. I'd say that's absolutely the exception and not the rule. And what I learned from Bryan is you have to be willing to build out a track of increasing spend incrementally on a daily basis or a weekly basis or every other day, some schedule. Because if you don't scale spend, you won't scale your brand unless you have some non-ad driven acquisition engine. And that really changed my whole perspective, seeing what you have done. And I can't name any numbers because it's confidential, but just so the audience knows, Bryan and Sam scaled, and on the back of Bryan's ad spend, they scaled from 0 to healthy 8 figures in like 2 years. It was absolutely incredible. And so walk me through a little bit, Bryan. Like, obviously we don't have enough time to get into all the nuances, but walk me through how you think about the best practices involved in like laying out a schedule or a plan to scale ad spend over time. Because there's a right way to do it and a wrong way to do it. And I think your brain is filled with tons of best practices and lessons learned on the right ways to do that.
Well, and I've seen firsthand the wrong way. I'll give a quick anecdote. Before, I think a year and a half, maybe 2 years before I was working with Nude, I was working on a different company in Australia, and they brought me on to basically help them with their go-to-market for the US, and they really wanted to scale. And I 5X this business in 3 months. Um, and against all like red flags, we did it. We like scaled. They were hitting record-breaking numbers, 5X in just a few months, and their business was not prepared to handle it.
Mm-hmm.
Acquisition, ROAS, all of the MER, all of our metrics and KPIs to measure the efficiency of our ad spend, those were holding. Things were great. In fact, there was more signal. Things were even performing slightly better by like 5 to 10%. But everything else that's behind the scenes that I think people often forget about, and it's not as glamorous, it's not the thing that comes to mind, that all unfortunately was overlooked, and margins were squeezed. I think the gross margins of the business were like 60%, 65%, and after everything it got squeezed down to like 3 to 5. I'm
Mm.
talking the number of customer service agents that they needed to hire, the logistics and fulfillment, pick and pack. They had their own warehouse. They were out of Australia, so they could very easily source, pick and pack right there, and then ship out. So they needed to hire a lot more people. Not just that, but the people that they had to pay overtime to handle the influx of orders. Um, so tons of human capital just got sucked up right there. Not taking into account things like returns, higher return volume from the previous months, right? As you sort of, you start to hit those sort of stair stepping scale exercises, and just a plethora of these hidden expenses started to like surface up, completely ate the margins of the business. And so I think with seeing that firsthand, it's kind of created this checks and balances, if you will, a sort of a checklist. And I think that's what we did exceptionally well with you is having very candid and transparent conversations about, can we afford this? What does it look like? How do our lines of credit, if we needed to pull the trigger on supplementing any OpEx, like do we have the credit or the funds to do so? And there were a lot of terminology that I ended up learning from you, like quick working capital, right? And like how many, what is the future debt, and how does that affect the net quick working capital and all of that? And I thought that was absolutely brilliant. When we going back to your question of how laid out a plan to scale Nude, it's actually quite simple, right? You want to basically lay out, you know, a spreadsheet where one column is all of your days or your weeks, and you just go all the way down for the rest of the year. The next column is your current spend. That'll be your actuals column. And then you'll have two additional columns where it'll be your forecast spend and your like, your scale plan. And so your scale plan is really what's driving the scale, right? So let's say your scale plan is, we want to scale every other week. And so we want to scale every other week by 20%. And how we do that is by scaling, 10% on Mondays, Wednesdays, and Fridays. Because those are our best days, and we give a little bit of breathing room before. And so you would go into the spreadsheet on Mondays, Wednesdays, Fridays, you type in 10%, and you would basically map out your forecasted spend to increase 10% on those given days. And then you can check in and see, okay, does this plan allow us to scale every 2 weeks by our target spend plan? And you, as you get your actuals in, you punch those in and you course correct the scale plan. So maybe you did 30%, maybe it was a phenomenal week. So 30% is what we did last week. We want to continue our pace of 10% every other week. So now the plan is elevated a little bit more. And with the beauty of that, it's one, it's so simple. Two, you're actually seeing where your spend, what your spend is. And so there gets to a point where like that 10% increase is not as simple, right? Going from $500 to $550 is very different from going from $100,000 to $110,000. And so I think you definitely want to be, realistic and not and look out for those periods where the scale plan doesn't work anymore, just doesn't make sense, and you want to pull back those numbers or keep them flat. The biggest advice I have for people is stair stepping your scale. It should not be linear. It should not just be up and to the right. It
Mm,
should be like going up a series of stairs. So you scale and then you hold for a little bit, right? Like give yourself about a week or two to hold to make sure that one, things are stable, two, that there aren't any of those hidden traps, right? That the business isn't aware of, customer service tickets, returns, maybe because you rushed this batch of inventory, the quality assurance of the factory has come down because they just need to get product out of the door. And so maybe there's defects or maybe there's like lower quality products that are now getting returned. So you want to give yourself about a week. And maybe a week isn't long enough. So really base this on your business, but give yourself time to make sure that things are stable and then go back up and scale and then give yourself time up and scale and give yourself and I think that is it takes a lot of discipline. You have to be very transparent and honest. And one, are we hitting the pace? Are we going too aggressive? We need to stick to the plan. And it sort of requires patience because when you see that things are going well, you're going to want to go, well, let's just flatten that out and get aggressive and go up and to the
for
right.
sure.
And I think we had this was like a topic of discussion of many times with Sam, you and I, where there was a lot of eagerness and we almost wanted to like flatten those stairs out and just say, no, 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 like let's just go. Let's just keep going. It's like, no, we definitely need to establish that discipline because it's the only way when you give yourself a breathing room and you try to stabilize and you say, okay, what does the business look like when we are at this pace for a little bit? That's when you start to surface all of the issues and you want to surface those early on when your spend is down here
For sure.
at like $10,000 a day versus when your spend is like up here at $100,000 a day. That the magnitude of the problems just becomes so much larger. So it's best to catch them early.
So, believe it or not, Brian, that advice right there is next level for probably most of the people listening to this podcast and a lot of the brands that we work with. Um, there are plenty of really talented ad buyers out there, but there are more that don't know what they're doing than there are ones that are really, really talented. So unfortunately, I think a lot of D2C brands get freaked out and become
Mhm.
gun shy because they've had some bad experiences with some poor ad buyers. But what you just laid out there, honestly, I got a master class in this just working with you for the last year and a half and learned a lot more. I thought I knew about scaling ad spend until I worked with you and Nude and realized how much I didn't know. There's a couple of things I want to summarize to point out here so that the audience can kind of let this sink into their mind. One, the days of the week thing, super huge, right? You hear how Bryan was being very intentional about what days of the week should he scale spend because he had data on which days perform better than others, and he wanted to scale into the days where Nude typically has better performance. That's super huge. The other thing is the stair stepping, right? Is that you have some period where when you increase spend, you're staying level and you're watching the data and making sure your performance is holding before you take the next stair step. And then knowing when to pull back or just hold because your marketing efficiency ratio or what we call MER at Nude, and a lot of people call it MER because of Bryan and Sam. I call it MER, and I've been spreading that across our client base. But that's a side note. But yeah, knowing when your MER is breaking down, knowing when to hold or pull back. Now, I want to dig into something that Bryan talked about for a second, which was margins and how important that is. Gross margin, which at Free to Grow CFO, we call gross margin the margin that just takes into account landed product costs. And then after that, we back out shipping and fulfillment and credit card fees, and we call that contribution margin before marketing. Um, again, we can't name specific numbers, but Nude has healthy contribution margin before marketing. There's a lot of room. I would say there's above average room to spend on advertising relative to the average D2C brand. Um, walk through. I just love to hear a little bit from you when you've got healthy margins to work with, right? How does how does that change the calculus of your planning and what you feel that you're able to do in terms of scaling ad spend, and kind of compare like, hey, I've got two scenarios. I've either got a brand with like really healthy contribution margin before marketing, or another one that's quite a bit slimmer. How does that change what you think is possible and how you set forth a scaling plan from the ad buying perspective?
Yeah. When you have healthy contribution margins just before marketing, it allows you to afford a higher customer acquisition cost. In short, you can be way more aggressive. Now, you want to find this balance between efficiency, right, and scale. And I was actually talking to a buddy, Cody Plofker over at Jones Road Beauty. He's a CMO with them, and he recently switched from looking at contribution margin ratio or the percent, and started looking at contribution margin dollars. He wants
Yep.
volume of dollars. And he's
Yep.
like, you know what? If my margin goes from 10% or 15, or theirs is probably higher. My margin goes from 30% and it squeezes all the way down to 15 or 10. That's okay because I'm yielding more volume. And so I think this is where you need to have a very honest conversation and really establish the KPI that you're after. And look, like we want our cake and we want to eat it too in terms of, well, we want volume, we want efficiency. Let's have both, but you have to prioritize one, or there has to be agreement on prioritizing one, or else you're gonna try to solve for them both, and you're gonna get stuck. You're not gonna be able to scale this way. If you want to solve for both, just don't spend. scale
For
scale
sure. For
down.
sure. For sure.
Um, but I think the biggest, when it comes to how do you think about it between a high margin contribution margin brand before marketing versus low, you need to really plot out and exercise. And I think working with a CFO team like John, where you can look at both scenarios and you can like scale them out, and you say, okay, at $5,000 daily spend at this ROAS, it's basically a matrix, right? Spend on one column, ROAS on the other, going from zero spend to say $50,000 daily spend, and then going from like a 1.5 ROAS, below your break even, all the way up to well above your break even. And you want to see like what is the ratio, contribution margin ratio. Is it 10% over here? Is it 50% over here? What about down here? How's that compare? And you want to basically look at that table and say, okay, where are we happy? Okay, we're happy at spending $100,000 a day in spend, and maybe we're happy doing that at a 2.5x ROAS. Or you know what, maybe that is equivalent to spending $25,000 in day of spend at a 3x ROAS. And so you really need to have that conversation and what is best for your business, right? Are you going for market share? Are you going for profitability and sort of steady profit growth, because you in the next 2 or 3 years you need to show year over year growth. So you want to keep things slow and stable. And I think that's where you need to really understand the vision of your business. You need to, kind of get a sense of what is the most important thing. If you're in a hyper competitive space, maybe you need to be more aggressive than you normally would because you need to be the number one in the space. Or if you are in a less saturated space and you're kind of creating the category a little bit, you can go a little bit slow and steady because there's a lot more white space. You don't have a ton of competitors. But I think that's the biggest, the most important exercise is laying that out and sort of comparing the two. And if you have high contribution margins, then I'll say you can probably afford a higher CAC, a lower ROAS. If you have squeezed in margins, you're definitely going to need to find what is that balance, because your margins are already tight. And I think this then opens up the conversation of, do we have any lifetime value? I worked with brands before where like their ROAS goal was a zero point 0.7. They were like, Bryan, anything above a 0.7, we're ecstatic, we're happy. And at first glance, we're like, well, wait a second, this business wants to lose money, but they had such an incredible product that just drove an insane amount of repeat that a zero point 0.7 allowed them to be hyper aggressive. Their margins were already squeezed. They didn't have a ton of contribution margin to begin with. So 0.7 was like, this is what works for us. and they were really banking on a 2-to-1 CAC ratio, LTV to CAC ratio. So they were looking to get paid back within 2 months, and it worked for them, right? It takes a little bit more sophistication than money out, money in, because they're really like, at first they were leaning on tons of lines of credit and debt, but now they've got this such strong customer base that all of this, the recurrent revenue, is what's driving future revenue, and so they have to think about it a little bit a little bit more laid out of like, okay, what is the current cash flow of our existing, and how many new customers can that afford to get us? And then next month, now that we have acquired those customers, we know some of them are going to come back, and how does that help us with future acquisitions? So they really think about it in cohort cycles.
Mm-hmm.
But a lot of this is going to be dependent on your brand, but there's definitely some options there, right? You can go super aggressive, low ROAS, high CAC, or you can go more methodical. And then if your margins are squeezed, you need some sort of LTV or repeat in order to be able to scale. If
So
not, I
I
would
want to
solve for that first before scaling.
totally. No, that's such great advice, and I want to call something out here that like I want to bring awareness to something that I'm noticing in what Bryan is walking you guys through in this episode. Bryan is VP of marketing, but he's sitting here talking about awareness of cash flow and awareness of operations ability to keep up with scaling ad spend. He's talking about contribution margin dollars. These are all non-marketing, aspects of a D2C brand. And the point I want to make for everyone is that whoever's driving the marketing strategy in your business, and definitely whoever's driving the ad spend strategy, they can't do it in a vacuum, right? They need to be aware of your operations functions ability to keep up. They need to understand how what they're doing is impacting cash flow. They need to understand how what they're doing is impacting profitability, and hopefully with a lens on contribution margin dollars and how they're driving contribution margin dollars. When I first started working with Bryan at Nood, I distinctly remember many different conversations of like, hey, I think I can scale ad spend, but am I going to sell through all of our inventory? And like, are you sure we're not going to run out of inventory, John? Because I can scale this ad spend, but if we run out of inventory, it's going to screw up my conversion signal. I'm going to have to cut spend, and I'm going to have to start at a new floor. And so that whole stair step that we've been talking about for the last little bit here, he has to start at the bottom of that staircase again because we ran out of inventory, and he's got to do it all over again. There's no magic like just coming straight back up to the floor the spend floor that you were at before you ran out of inventory. And so the awareness of whoever's driving marketing has to have keen awareness and connecting points, connecting communication and reporting points to your operations team and your finance team. One thing that we started doing at Nood like a year and a half ago was something that I put in place at Guardian Bikes and kind of brought that to Nood when I started working with them as a fractional CFO, which is what we call our cross-functional planning meeting. It's a 30-minute touch base once a week. We now do it once every other week, but like some regular touch base where you have whoever owns inventory planning, whoever owns ad spend, and then whoever owns cash planning and basically like your projections and forecasting from a financial standpoint. And it's a simple meeting to make sure everyone's on the same page, because it's a three-legged stool is the way that I like to think about it. If you take one of those legs off, the stool falls over, right? And so super, super important that your marketing spend is planned out and executed in a cross-functional context. And then, so there's one other thing I want to dive into a little bit deeper. I talk about this a lot on LinkedIn, and it's a hot topic out in the marketplace, contribution margin, but dollars versus what's called the contribution margin ratio, which is the percentage of revenue. It's important to know the percentage of revenue, but what I always like to say is percentages of revenue don't pay bills, dollars pay bills, right? So it matters how many dollars you're generating. And for those of you who don't know, contribution margin dollars, the definition is net revenue minus all variable costs. So variable costs meaning landed product costs, shipping and fulfillment, credit card fees, and advertising spend. So what does contribution margin dollars represent? Here's what it represents. The number of dollars left over after a customer is acquired and an order is fulfilled. It's the dollars that stay in your bank account that are available to contribute to or cover your fixed overhead, right? And if you generate more contribution margin dollars than your fixed overhead, those contribution margin dollars then contribute to or increase bottom line profitability. And so what Bryan was talking about earlier was, hey, the percentage, you should know it. It should be one of your KPIs. But what really matters is how many dollars of contribution margin you're generating after your ad spend, because that's what covers your overhead and then hopefully covers your overhead and drops to your bottom line profitability. And there are times in which this isn't always the case. We tested this a lot at Nood. There were times when we tried to scale spend and our contribution margin ratio or percentage of revenue went so low that we actually generated less dollars, right? But there is this counterintuitive situation where you actually can spend more and your ROAS or your MER comes down, but you actually can generate more contribution margin dollars. And that's what, generally speaking, if you're trying to maximize profitability or increase profitability, it's the margin dollars that matter. Now here's the nuance in practice, and I'd love to talk about this a little bit because honestly, I honed this skill, no joke, in large part working with Bryan. And like let's be fair to Sam. Sam gets a lot of credit for this too, and I know you'll agree, Bryan. Like Sam has been very rigorous about making us focus on daily contribution margin dollars, which rightfully so. Like I have a lot of respect for Sam forcing us to really focus on that and forcing us to figure out how to measure that as accurately as possible. Like and I don't want to go on a tangent, but there's just so much that we have developed organically in terms of a process of how finance and marketing should work together, specifically at Nood. Like Bryan is tracking contribution margin dollars generated on a daily basis, and at the end of the month, we're almost dead on with our actuals when the financials get closed, right? And it's a partnership. Like finance, I'm always letting Bryan know, hey, our margins have changed a little bit. You need to change your formula, and here's why they've changed. Oh, we've changed price points. If we change price points, our contribution margin for each order is going to be this on Amazon and this on direct. So it's definitely a partnership. But I just want everyone to understand, like, we are measuring contribution margin dollars on a daily basis, and our estimate almost perfectly ladders up to the financials at the end of every month. A lot of rigor, but not rocket science. Totally doable, right? It's totally doable. How has that changed your perspective on ad buying on a day in and day out? Like us getting so rigorous about we can forecast on a daily basis contribution margin dollars that we think we've generated, and it's so accurate.
I think it's, well, before I dive into the question, it's an ever growing continual progression and just improvement, I guess, of this. It's been improvement for well over a year now, and I don't know if you saw the latest. So every morning at 6 in the morning, is it 6:58 a.m. we get a Slack notification that's automatic, and it's basically the previous day's report, and it's got contribution dollar margin, it's got contribution dollars, it's got it by channel, Amazon versus Shopify, and then the latest addition in this exercise towards progress and improvement. The latest addition is I've added rolling 7-day, 8 to 14 day, 15 to 21 day, and 22 to 28 days. So basically, I have like week 1, week 2, week 3, week 4 to see the progression. That's the latest addition over the weekend. So we're measuring this thing.
And we all check it every day. I work with several other brands, and I still check it every single day, 7 days a week, just because I want to.
Yeah, I wake up. It's the first thing I look at in the morning. A bit unhealthy. But how has this affected my ability to media buy and just execute marketing in general? Oh my gosh, it is, measurement and attribution is something that's so difficult, and the platforms, yes, they try, and you try to make the find the right tools, and there are certainly tools that help. But if you are like, look, we we don't have the funds to invest on a $5,000 attribution platform or a measurement partner. This will allow you to measure. Very simply put, because when you activate these funds, you will see the impact in your contribution margin dollars. And when you are doing this on a daily basis, you can definitely see that impact, right? Whether there is an impact or not. I'll give you a plethora of examples. One, Amazon. Um, one day I was just like, you know what? Let's cut Amazon spend. Just cut it entirely. I don't believe Amazon. I've yet to be given proof and evidence and reason to believe that Amazon is incremental to the business. We were spending about $100,000 on Amazon ads. Cut it. The next day, contribution margin dollars hold. Contribution margin as well. When you look at them side by side, that holds. In fact, no, sorry, not it didn't hold. It got better. You
Yeah,
know
it
that
got way better. It
it
got
got
way
way
better.
better. We were spending that money, and we were like that money that we just cut. The expense was added directly into our contribution dollar margin, and that stuck. I was like, hold that for about 2 to 3 weeks. It stayed the same to this day. We cut this back in November. Risky move doing this before holiday. We cut it in November. Still the same margin. Great. Validation. We don't need Amazon ads. That didn't take a rocket science measurement tool or match market geo testing with holdouts and all this stuff. You can definitely do that, and I would have a much more accurate view. But this just measuring on a daily basis just allows you to get more accurate. Right now, I'm going to be doing some stuff with TV and Snapchat and TikTok, and I'm scaling TikTok ads. And these are platforms that are very view through heavy. They're very difficult to measure. There's not a ton of click involved. But the beauty of measuring contribution dollars on a daily basis is that when I deploy this capital, I will see the impact right away. Now, maybe I won't see the impact on day one or day two, but I'll definitely see the impact by week 2 or week 3. And I can make a very quick decision and say, okay, I spent $10,000 and now my daily contribution margin is or dollar ratio is $10,000 less than the average, and it's continued to be $10,000 less. It's probably not an incremental expense, So I
I
think
love
this
that.
just
I love
allows you
that.
to be super methodical and very intentional with your media buys versus kind of putting it out into the air and relying on some sort of attribution tool to tell you what's happening. You actually get to see it.
Yeah, man, we're gonna have to talk another time because we're not gonna get to everything that I've learned on the scaling ad spend front today. But let's just keep riffing on what we can here. There's like 3 different things I want to dive into on what you just said. I'm gonna have to choose one. Um, okay, first off, it is in the world of attribution being just super challenging, right? And other issues like Triple Whale has ad spend in their ROAS calculation. You have to manually know how to take that out. There's like so many issues with attribution platform tools. Not that they're useless, but that, fair warning, know how to use them, know what's actually behind the data, right? But given that that's the world we're in post iOS 14, like for Nude to be able to make a incremental ad spend change, whether it's in a new channel or within existing channels, and come back and look at the daily impact to contribution margin dollars. That is huge in terms of assessing, because at the end of the day, isn't that what matters, right? What matters is that the changes you make on the ad spend front, they either positively impact bottom line, which the best way to measure it is contribution margin dollars, or they negatively impact it. So now you have to be methodical. We can't make a bunch of different changes all on the same day and then assume that
Right.
one of those is what's impacting contribution margin dollars, right? So you've got to be methodical about it. No different than doing a A/B test that you run with some A/B testing app, right? But if you see contribution margin dollars heading in the right direction, heading up as you're making these changes, and it's doing so in a positive correlation with these ad spend changes that you're making, then you can likely assume that that move is incremental to your bottom line. That's what Bryan is saying. Okay, so I want to double click into the Omni-Channel performance measurement. So at Nude, we've got Amazon and Shopify or we'll call it Amazon and Meta, right? As like the primary kind of like the primary drivers. Yes, Google's a part of it all, right? Like you can't disconnect Google from Meta, but let's just say like we think about the business as direct, being Shopify and Amazon, and there's been a lot of messing around with ad spend allocations on the Amazon side of things, right? And like there's no doubt that like Amazon, that Meta is driving that top of funnel spend is definitely driving demand on Amazon. And there's always been this question mark around like, okay, the PPC advertising on Amazon, is it actually doing anything, right? Or is it just all coming from Meta, and are we just basically like cannibalizing our margin
Mhm.
by double spending, by spending on the PPC side of things on the Amazon platform? Bryan and Sam have done a lot of very interesting tests, but I want to talk specifically because this is something I would have never thought of. You brought it up to me many times, and I would say that we've had at least a few instances where it appears that this kind of theory you had um, is validated. Talk about the conversion signal, this theory you have about the conversion signal on
Mhm.
Meta, and how what you do on Amazon from an advertising ad spend standpoint might be messing with that conversion signal.
Oh yeah. So
By the way, I'm going to cut you off. This was next level to me. I think this is going to be next level to a lot of people. And again, it's still a theory. We don't have necessarily empirical evidence, but we have data that shows
yeah,
a direct correlation. And so I believe it to be true.
yeah. So I think we need to start with like the things we absolutely know. There is a market of people that will only buy on Amazon, right? They are just they just prefer it. They pay for Prime. They want to get the most out of Prime. They like the faster shipping or the customer guarantees and protection. And so that group of customers will always be there. And then you have this sort of tranche of customers that exist, and they're kind of like they'll buy on Amazon. It's more of a convenience thing, right? But they'll also buy from your site. And if it's really wherever the best deal is. And then you have the tranche of customers that are like, I don't really prefer Amazon. I'd rather just buy from the site. I'm comfortable buying from the site. So those three tranches of customers. So these two on the extreme, the tranche that only buys on Amazon and the tranche that's going to buy on Shopify, they're there. They're going to exist. It's the middle crowd that worries me. And what we discovered is that when we play around, and this was almost, I don't even know if this was intentional. I think it was accidental. We had to do this because of retail partnerships where we had a price match with our retailers. So we're in Best Buy and Target, and they were like, "Hey, your price on Amazon is a lot lower than our price on our website. What's the deal?" So we're like, "Oops, sorry." So we raised the price on Amazon, and that created a price variance. So we used to have this price match, right, between Amazon and Shopify. And Amazon was about 30%, 30 to 35% of Shopify, meaning that Amazon as a halo, by this time we had already cut our ads on Amazon. So just by proxy of halo effect from our meta ads and all the awareness that the brand's been driving, um, 35% of sales would move over into Amazon. When we increased the price, that number dropped down from 30 to 35, all the way down to like 12 to 15. So it nearly cut in half. And the sort of a $30 price change was what caused that. So then this raised this question of like, okay, wait a second. What is this relationship between price disparity between the two channels and the percent of sales? And we started to play around and test it. And this is when I started to sort of realize that whenever we drive more sales volume back into Shopify, you are protecting the conversion signal of your ad auctions. And
On Meta, your Meta
on
ad
Meta,
auction conversion
yes,
signal.
specifically on Meta. And I think that's the most important, right? So you have a business that we know is driving a halo effect from Meta ads to Amazon. We know that a percentage of those conversions that Meta is driving are not being given back to the platform, um, as conversion signal, and I'll tap into that in a second. And we know that Meta is your primary sales engine. So I kind of came with this philosophy of we have to protect our sales engine. We need Meta to realize that the ads that it's serving to all of these people, that they are actual buyers, so that it can get better at finding the next tranche of buyers. And my concern was, because then we started to play around with price, and they were like, wait, but there's more margin on Amazon, or there's less margin on Amazon. And my concern was that all like this tranche of people that should be buying on Shopify are now buying on Amazon. There's a few concerns there. One, the obvious one is I don't own those customers. Amazon does. Those are Amazon's customers. They keep the personal identifiable information. I don't. So any email addresses, if I want to do remarketing or anything like that, lookalikes, that's all gone. But more importantly, the conversion signal on Meta, but I had this theory that basically if Meta is serving the ad to the right customer, and then that right customer is not buying, right, in Meta's eyes, it's
Because they're
going
buying on
to think,
Amazon.
in their because they're buying on Amazon, it's going to think that this is not the right customer and needs to go and experiment and try to find other pockets of customers instead. Again, Meta operates on an OCPM auction. It's an optimized CPM auction, meaning the price is dynamic. Each user is a different value based on the propensity of that user or the confidence of that user to actually convert for your site. And so the closest I got to actually measuring this was we basically dropped the price back down to price matching. This was around December and January, and then we like raised the price back up. And I did see an immediate boost to conversion to Meta's conversion rate and Meta's ROAS. I think we were, I can't give numbers, but it was like about a 15 to 20% improvement in ROAS week over week from whenever the price was the same and those people were buying on Amazon to when we increased the price. Obviously, that's because those people are buying, and so the platform believes it's a higher ROAS. But if you've got different bidding strategies or you're trying to optimize for return on ad spend on Meta's auction, having that signal is going to be crucial to effectively media buy, especially if you have media buyers that aren't close to the business, to the financials, right? Like I have the luxury to look at the business and say, oh yeah, this is the impact. But if you've got agencies or you've got people that are a bit more separated from the finance, they're going to legitimately think that the ROAS that they're seeing is bad, and they're going to make bad decisions, wrong decisions, I should say, on which ads to pause or scale because the signal isn't being fed back into the ad auction.
Man, next level advice for the people listening right now. Now, again, this is a theory. Um, don't spend all of your dollars on feeding the meta beast and then come back and send Bryan
It
really
didn't
angry
work.
emails that he was wrong. But I think it's important to share this learning. This might be happening to you if you have both a Shopify and an Amazon store. So definitely something to think about. Definitely something to think about. Not all sales are equal, and understanding how the meta algorithm works is super, super important. That's one place where Bryan knows a lot.
I think what you just said there is probably the most important. I think this is that in that next level of progression, right, and continuing to get better. Not every sale is equal. That's important across all channels of your business. So Amazon versus Shopify, do you have a lower or higher return rate between one or the other, right? Keep in mind how that contribution margin formula is calculated. Returns go into that. So if your return rate is higher on one channel and it's significantly lower on the other channel, the contribution margin ratio between those two channels is going to be different. One of those channels may just inherently be more profitable to acquire on than the other. Maybe shipping, if you're in like beverage, shipping on Shopify is going to kill your margins versus shipping on Amazon. There is no, it's FBA. So think about those, and then not just that, but also like Meta ads versus Google versus TikTok, or even email and SMS, right? Like, do you have to send out 3 emails that have little images that eat into your margin text messages that eat into your margin to acquire a customer, or can you send a plain text email to acquire that same customer? That's going to have a difference in your margin and your contribution margin ratio. Same with Meta ads or TikTok ads, especially if like we have to offer 20% off on Meta ads, but on TikTok we can do it through shops, and TikTok is subsidizing the discount for us. so we have a higher margin there. So I think like we've done an exceptional job at looking at holistically, and even at channel level between Amazon and Shopify. um, I am now getting curious and going down to like my acquisition channels and saying like, okay, Meta versus TikTok, where can I like squeeze more profitability out of this, and how to not get misguided by a higher ROAS number, because the ROAS number may be higher over here, but the margin may actually be lower versus this one. The ROAS is lower, but the margin is higher. So thinking about it that way, I think is key as well.
All right, everyone. This was a master class in scaling ad spend. Again, without mentioning specific numbers, Bryan, over his career, uh, he's managed millions of dollars of ad spend a month himself, right? Not a lot of people can say that. And so these learnings are coming from someone who's been in the trenches.
Still am.
Mind you, not all easy. Bryan has had plenty of sleepless nights, and I mean it takes dedication, and you have to roll with the ups and the wins as much as you have to roll with the downs and the valleys, and like again, it's not all up and to the right. It's stair step, and I would even say it's probably a little bit more like the stock market. You got to retreat sometimes and then stair step back up and then retreat, but you're always retreating hopefully to a new floor that's higher than your previous floor, right? And so the scaling of ad spend is a journey if you want to be holding it within the profitability constraints that you have as a business. Keep in mind, Nude is completely bootstrapped. Like there's a small amount of capital that the founder Sam started this business with, and other than that, just lines of credit that I've helped the business get, that they've scaled to very healthy 8 figures. So if you want to, if the lessons you're learning here are from, Bryan, you're very humble, so it's okay if you don't agree with this, but Bryan is a ad spend scaling guru, managed millions of dollars of ad spend a month for many years, and has helped scale a bootstrap brand to that point. So super, super, again, just like a PhD masterclass here on like some of the do's and don'ts of scaling your ad spend. Before we end, I'd love to just have you share with the audience, because I know you personally that you're like a lifelong learner. What's something you're reading or listening to or learning right now that has just like really, really been impactful for you recently?
Wow. Hmm. I think right now the where I'm most interested is in AI. Obviously as everyone is, but I think really more in terms of how do I productize some of my learnings and ideas, and not productize it to sell it, but productize it in a way to like help me. So I've been playing around with a lot of the GPTs and watching a lot of YouTube videos, and putting that to the exercise. So I have all my training manuals from when I was a manager of media buyers, and all of these like data samples and all, and I'm feeding the GPT, and I'm basically looking to train it to, in a way, try to clone my brain, if you will.
That's so
And
cool.
I've got it to the point now where you can export your data and you can upload it into the GPT, and it'll tell you, here's what I'm seeing, here's the optimizations you should make. And basically it lays out a test and learn for you with like next steps based on the data. So you give it like creative level data or ad set level data, and it does this. It's not always 100%. I'm still tweaking it, but that's been kind of this like little hobby, or it's becoming a hobby, is how do I train an AI to think like me as a marketer and media buyer.
Dang, I'm gonna have to get into that. I'm gonna be picking your brain on that outside of this. So lastly, where can people find more info on what you guys are doing over at Nude?
Yeah, LinkedIn's always the best. It's just my name, Bryan Cano, Cano. Is my LinkedIn. I'm also pretty active on Twitter, or I should say X now. So with that one, just it's got my middle initial, my first name, middle initial E, and then last name Cano. So you can find me on Twitter. And Twitter, I don't really talk about Nude specifically. There will be some anecdotes here and there, but it's mostly just like, here's like what I'm seeing, some trends. And then, I'll be at the Whaleys in April. I'll be speaking with Nick and Moyes on the Limited Supply podcast. So
Awesome.
uh, you can catch me there. But yeah, I'm pretty accessible online. And if there's any questions or just have one perspective on something, I'm always available to help out on over DMs.
Awesome. Well, I know that everyone got a lot about out of today's episode. I appreciate you joining Bryan. And until next time, everyone, keep scaling on. It's a journey. There's ups, there's downs, but hopefully this podcast helps you be able to endure through some of the challenges of scaling your ad spend that much better than you were able to do before you listened. So until next time, scale on and chat with you guys soon.